Hi everyone, welcome back to What If Money. Today we're asking a huge question. What if the world's safest currency suddenly became the riskiest thing in your portfolio? Because in 2025, that's kind of what happened. From January to June, the US dollar had its worst first half in nearly 50 years, dropping over 10% on the dollar index. Now, this isn't some volatile crypto token, this is the dollar, the benchmark for global assets. A 10% drop in the benchmark is like everybody on Earth waking up 10% taller. Nothing has changed, but everything measures differently. And while this was happening, gold exploded to record highs. Bitcoin smashed past old peaks. US stocks crashed in April, then ripped higher into the second half. The safe thing fell, the risky things rose. So today, we're breaking down the perfect storm that broke the dollar. At the start of 2025, everything pointed to a strong dollar. The US had high interest rates, decent economic growth, and global investors were hiding out in US assets as a safe haven.
It was the default choice. Then April happened. The US announced a sweeping round of aggressive tariffs on its key trading partners, not just China, but allies like Canada and Mexico. Markets panicked. Stocks immediately sold off. And here's the twist. Normally, in a crisis, investors run toward the dollar. It's the global shelter. This time, they ran away. The realization dawned on investors everywhere. I didn't buy dollars to become the risk. I bought them to escape the risk. But now the risk is US policy. And in that moment, the dollar stopped acting like a safe haven and started acting like just another risk asset. That was the first crack. But as we moved into the middle of the year, the economy itself began to slow. Job data softened. Inflation finally cooled. So the Federal Reserve did what it always does when it gets worried. It prepared to start cutting interest rates. Now, lower rates create a double problem for a currency.
First, they mean you get less yield for holding dollars, so there's less incentive to own them. Second, they act as a global signal that the central bank is more worried about jobs than it is about inflation. So now, the dollar had two anchors dragging it down, a sudden political shock from tariffs, and now a falling yield advantage as the Fed pivoted. And that wasn't even the biggest surprise. Then came the bombshell. The government revised its employment numbers, and it revealed that from April 2024 to March 2025, the US economy hadn't created as many jobs as we thought. In fact, it had created over 900,000 fewer jobs than originally reported. Almost 1 million jobs simply vanished on a revision. That meant the economy was weaker the entire time, and nobody knew. For a global investor, this is the final straw. You now have weak fundamentals, you have a central bank cutting rates, and you have radical political uncertainty. It's a complete breakdown of trust. So by the time we hit summer, you had the perfect storm. The dollar was falling, the Fed was easing, and the underlying data wasn't as strong as advertised. The first half of 2025 wasn't just a bad 6 months for a currency. It was a fundamental reevaluation of risk, a moment when the world's financial bedrock started to feel like quicksand. And it leaves us with a critical question moving forward. When the safest thing in the world is no longer safe, where do you turn? And what does that mean for the money in your pocket?
Money is a story we all agree to believe in. It's a story of trust. But what happens when that trust begins to fray? When confidence in the usual places, governments, central banks, even economic data starts to look shaky? Where does all that value, all that belief go? This year, we got a clear answer. It went looking for something solid, something real. It went straight into gold. And gold didn't just have a good year, it had a main character year. We saw new all-time highs. We saw massive inflows into gold-backed funds, with North America buying more aggressively than ever before. But why? The simplest reason is that gold is priced in dollars. So when the US dollar falls, as it has been, the price of gold automatically re-rates higher. It's simple math. But the deeper reason is about trust. When investors start questioning US deficits or political gridlock, or whether the economic numbers we saw last month will be revised away next month, gold becomes the simplest hedge in the world.
Think about it. Gold has no elections. It doesn't have policy panic. It doesn't have an inflation target to miss. It will never issue a press release saying, sorry, we revised the last 12 months. Gold just exists. It's the ultimate escape from complexity. Now, here's where the story gets strange. While the dollar was weakening, while all this trust was flowing into gold, something that shouldn't happen happened. US stocks, especially the big names in AI and tech, absolutely soared. Normally, that's impossible. When foreign investors pile into US stocks, they have to buy US dollars to do it, which pushes the dollar's value up. But not this time. The old rules broke. This year, foreign investors did something new. They bought the US stocks and then they hedged the dollar. So a big fund in Europe or Canada would buy a ton of Nvidia, but at the same time, they would short the dollar in the currency markets. They effectively said, we want the growth of your company, but we don't want the risk of your currency. The result? Stocks went up, but the dollar didn't get that usual boost. For the first time in memory, the historic link between the S&P 500 and the dollar was severed. This has huge implications. If you're an American, your portfolio looks incredible, but the measuring stick you're using is shrinking. And if you're Canadian or European, those amazing stock market gains start to shrink the moment you convert them back into your home currency. Suddenly, currency risk isn't just for big corporations. It matters to everyone. This trust rotation had one more major stop. As investors grew concerned about political interference in markets, fiscal sustainability, and the independence of central banks, the same logic that drove them to gold also drove them to Bitcoin. It became the digital gold hedge. We saw record-breaking inflows into the newly approved Bitcoin ETFs. We saw the price blast through new all-time highs, crossing $120,000. The idea of Bitcoin as a true store of value, a digital safe haven, was massively strengthened by the dollar's weakness. This isn't a recommendation, it's just the reality of where capital flowed this year. It wasn't three separate stories, gold, stocks, and Bitcoin, all rising for different reasons. It was one story, a story of a global search for certainty. It's a reminder that when the ground feels like it's shifting, people don't just look for returns, they look for refuge.
For decades, the US dollar has been the undisputed king of global finance, a safe harbor, the bedrock. But that bedrock is starting to shift. The dollar just had its worst first half in decades, and savvy investors are taking note, rotating away from cash and into assets like gold, Bitcoin, and even US equities. This isn't just a tremor, it's a fundamental change in the landscape. And it affects you, whether you live in the US or just next door. If you're in the United States, the combination of a weaker dollar and coming rate cuts rewrites the rules. First, your cash is no longer safe. A bank account with a low yield, combined with a currency that's losing value, means you are actively losing purchasing power. Every day, that dollar in your savings buys a little bit less. Second, global diversification is no longer a suggestion, it's a necessity. History shows us that when the dollar weakens, other assets tend to surge. We're talking about international stocks, emerging markets, and the raw materials that build our world, commodities, infrastructure, and real assets.
Your money needs a passport. Finally, rate cuts are changing who wins and who loses. For borrowers, it's good news. Loans get cheaper over time. But for savers, it's a tough pill to swallow as the yields on your CDs and T-bills start to dry up. Income assets like dividend stocks and bonds suddenly look a lot more attractive. Now, if you're listening from Canada, you're playing a completely different game. Your central bank is also cutting rates, but the Canadian dollar has been more stable. And your economy is rich in the very commodities that benefit from a weaker US dollar. This gives Canadian resource stocks a powerful tailwind. But here's the catch for Canadian investors. Your big gains in US stocks can shrink or even vanish when you convert them back into Canadian dollars. This is the new reality. FX strategy, foreign exchange, is now a part of your portfolio, whether you like it or not. You're not just an equity investor anymore. You're a currency investor. So, is this the end of the dollar? The short answer, no.
But the longer answer is that the story is changing. The dollar is still the world's main reserve currency, the primary currency for trade, and it backs the deepest bond market on the planet. But it's slowly shifting. It's not collapsing, it's becoming normal. It's moving from being the unquestioned king to being a very powerful currency that can be punished by the market like any other. And that normalization is reshaping the entire world of investing. This forces a critical mindset shift. We need to stop asking how many dollars do I have and start asking better questions. Questions like, how many years of my expenses can these assets cover? How many units of a productive business or a piece of real estate do I own? How much real purchasing power do I actually control? When the ruler you use to measure wealth is changing, the number on your account balance becomes less important than the real assets and real income streams you command. Currency risk is no longer a niche topic for Wall Street traders. It's officially part of everyday investing. The most important change isn't in your portfolio, it's in your perspective. Stay curious, stay informed, and take good care of your money.